You're still watching First Trades with me, Mansi Dave and Snehi Shah. And let's now talk about the earnings trajectory and deep dive into the insurance major HDFC Life. The company posted its first quarter FY26 results. And if we have a look at the earnings scorecard, it did miss our estimates with the annual premium equivalent slightly below estimates. At the same time, the value of new business margin and VNB also below estimates. On the year-on-year basis, it was an up move or at least a positive setup, but on a quarter-on-quarter basis, it was clearly a miss. To talk more on the same, we have the management of HDFC Life, Vibha Padalkar, MD and CEO, joining with us. Vibha, thank you so much for giving your time to ET Now. The first question to you is, what were the primary drivers behind the 12.5% year-on-year growth in the individual AP and the corresponding 12.7% rise in the value of new business? Were there specific product segments or channel that outperformed?
Our philosophy has been a balanced product mix as well as balanced distribution mix, and that came in very handy in the first quarter amidst a lot of macro turbulence that continues. So few segments that did very well was on the back of new product launches. Our participating segment grew over 100%. Our protection business grew by 19%. Annuity business grew by 25%. Unit link continued to be fairly well received by our customers. So that also grew about 15%. So it was fairly holistic. Most of our channels grew fairly well. Also, you talked about new business margins and value of new business. So the balance in our product mix, continued growth of protection faster than company level growth, both protection and annuity faster than company level growth. Inherent margins of unit linked also nicely trending upwards. PAR, of course, has been strengthening in terms of its margin, especially longer term participating products. So it was really holistic and coming together of many things. And the last point is on margins, since you talked about VNB growth. If you were to look at margins, actually, there's been an increase of 40 basis points in margins because we had the impact of surrender charges. So we started off with 25% in first quarter of last year. That went down by 30 basis points. So our starting point in a way was 24.7% margin, and then we ended at 25.1. So 40 basis points increase.
Hi, Vibha. Morning. You touched upon the VNB margin factor or that aspect of your earnings, and that has been slightly below what the street was expecting. Help us understand a more medium to long-term view in terms of the next 3 to 5 years. What could be the key contributors to the VNB margin expansion beyond the current 25 to 27% band? And could those new levels be sustainable going ahead?
Absolutely. We are still a very young country, and as protection and longevity protection products continue to be understood and then bought, I do believe that the growth in VNB or increase in VNB margins will continue to happen over the time frame that you're talking about. And while there will be some ups and downs due to macro or regulatory changes due to business model, inherent protection gap, inherent need for longevity protection and other solutions like that. Let's also see what's in the composite bill if that gets passed. So some of these things will be accretive to margin expansion. So we are reasonably confident that as a sector, margins will continue to expand over the 3-4 years that you mentioned.
Absolutely. We wish that the conviction for you and the confidence which is there stays in the coming quarters as well. Despite a broader perception of declining ULIP interest, your ULIP mix remains stable, which is a positive. What's supporting ULIP demand for HDFC Life, and how are you managing associated risks?
Frankly, it's for the sector. And within that, HDFC Life is in fact on the lower end. So we ended at around 38% on ULIPs, which is lower than about 43% that we were in Q4 of last year. So it's been in a way on a sequential decline, but nevertheless, like you mentioned, it's still fairly strong. I think unit-linked products are here to stay, and they are fairly simple to understand. What is our job is that we have to continue to increase and improve on our persistency. And that's exactly what we have been doing. You'll see that our persistency in the unit link segment has been inching up, and that helps in profitability and customer retention. Second point is on unit linked, how we can embed more protection in the form of additional life cover as well as riders. So that's the second point in terms of a lever for margins. And third point is that ability for us to cross-sell to the customers. So once we've got a unit-linked customer in the door as our new customers, then what do we cross-sell within the next 15 to 18 months? I think that has become almost a well-run engine within HDFC Life. 70% of our onboarded customers in Q1 have been new to HDFC Life. So the ability for us to cross-sell and upsell down the line is phenomenal. And even if they come in through the door as a unit-linked customer, we will upsell to them relevant products.
Right, Vibha, but if you talk about the share of pure protection policies, that is still in single digits right now. Do you think there is any scope to see any kind of uptick in this segment?
So that's, I feel, not the right way of looking at it, because if you look at the ticket size of a pure protection policy, I will have to sell almost 2.5 policies to make up for one savings policy. So the right way to look at this is in two parts. One is that is it that your pure protection is growing faster than company level growth? For us, it has been a resounding yes over multiple time frames. Take Q1, for example, retail protection grew by 19% versus overall APE growth of 13%, 12.5%. So that just means that the protection share will be going up. Second point is, in terms of the retail sum assured itself, that has grown very well. So 32%, overall in terms of 2-year CAGR. Plus, if you just look at the standalone basis, it's a 15% growth, but really it is every year that we have been growing very meaningfully on the sum assured. That just shows that more and more Indians are getting higher levels of cover. I think that's the right way to look at protection.
Agreed.
And there we have overall, we continue to maintain our leadership in overall sum assured. So I'm of the school of thought that the sector is doing fairly well in terms of evangelizing the need for pure protection.
Agreed. Vibha, moving ahead, what kind of impact there would be if a regulator brings some sort of restrictions on bank assurance business through parent bank, and how much of your business is through parent banks?
So I want to put this to rest that the government is extremely supportive and is focused on insurance for all by 2047. Now, if you deconstruct that, bank assurance and banks have almost 6 to 7x the reach in terms of branches versus the entire life insurance sector. It is next to impossible to get to the last mile in terms of penetration into tier 2 and 3 without this kind of reach. So the government is very supportive to say that they don't really have any intention to tinker with the format of the current bank assurance. However, in terms of missale complaints, every channel has to look at their own, respectively, their own parts of missale complaints, and also see how customer transparency can improve, right selling practices can improve operationally. One gives a little bit more leeway to customers and so on. I think that nobody can quibble with. Also, in terms of borrowing, that no customer would mandatorily have to take life insurance, especially in the non-MFI space, in order to avail of a loan. And again, there we have no disconnect. So this whole distraction about bank assurance, I think, is put to rest on that. Really, the focus should be on how do we expand the pie rather than just redistributing it amongst different channels of outreach to the customer.
Right, and Vibha, also let's talk about some new norms that we've seen in the life insurance space. Major life insurance companies are not in favor of the new open architecture of agents that we've seen in life insurance. What is the view you hold and HDFC Life holds about open architecture?
I think HDFC Life in general is of the school of thought that more decisions in the hands of entities so that we can focus on growth and expansion and increasing penetration in life insurance is the need of the hour. And so we are in a way neutral to whatever the government thinks and our regulator thinks is the right approach to in terms of going forward.
Okay, and RBI has also allowed strips in state government bonds. How will this allow insurance companies to manage their cash flows and align their income from investments with the future payouts to policyholders?
We are already using several hedging instruments, and this will only better in terms of our asset liability matching. This will just give us one more tool. This is a step in the right direction, and even our regulator is fairly supportive in looking at some of these hedging instruments, instruments wherein we can lock in long-term outcomes, reducing volatility, and so on. So we're very supportive, and hopefully there will be several more. That has been the ask of the sector.
Right, Vibha. And before we let you go on a lighter note, HDFC Life is celebrating 25 years of establishment. Tell us, what kind of bonanza can your policyholders, investors expect this year, and how do you see the journey of 25 years?
We are indeed very thankful to our customers, our investors, our partners, the regulator, and of course the shareholders, our promoters. And we have kickstarted this year of celebrations in terms of a lot of thought leadership programs, as well as engaging with our customers. A lot more will be revealed as we head towards the 25th anniversary in October. So please watch this.
Okay, Vibha, great chatting with you this morning. Thanks so much for joining us and taking the time out to speak to us at 80 Now. Well, viewers, with that, we'll slip into a very short break. Just word coming from the street, you also now have Nifty Bank in the Nifty Small Cap Index that have slipped into the red. No meaningful recovery coming in for Nifty 50. But on that note, we'll slip into a short break and be right back on the other side.